Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I have two guests from Ninepoint. So we have Jeff Sayer, portfolio manager at Ninepoint. We also have Chris Bean, managing director, head of corporate development at Ninepoint. How's it going, guys? Thanks so much for taking the time.
Hi,
Doing
Adrian.
great. Thanks, Adrian. Yeah. Thanks for having
Yeah,
us on.
thanks for having us
Awesome. So
on.
I'm excited to talk to you guys because we're going to discuss a product I never even knew existed. But when I saw the NAV discount, it kind of got me excited. So Ninepoint actually has a split share fund. So I'm just going to share my screen and show the audience here real quick. You guys have the Canadian Large Cap Leaders Split Corp. The stock symbol is NPS. And of course, like all split funds, there's NPS.PR, right, for the preferred shares. We're going to focus a little bit more on the Class A share, the NPS. And we will look at the distribution rate and the holdings in a second. But first, I want to ask you guys, why did you decide to launch a split share fund? It's a very competitive market out there. There's two major players. So tell me why you guys launched NPS in the first place.
Jeff, why don't you go ahead and I'll let you take that.
Yes, so we thought there was a compelling opportunity from a timing perspective when we launched the fund, Adrian. We were coming off one of the fastest tightening cycles in the United States. They had hiked interest rates, over 500 basis points of interest rate tightening. A lot of these really high quality dividend paying companies, especially in Canada, we thought were very attractively valued. Crude oil prices were down at the bottom of the range. And so we felt that there was a real opportunity here from a timing perspective, from a valuation perspective, to build and construct a split corp fund.
Mm-hmm. Yeah, okay, cool. So let's just look at the holdings real quick here. So you guys decided to go a little bit more concentrated. So in we have a few diversified Canadian stock split corps in Canada. So if I look at the holdings here, hopefully everyone's able to see it. You have 50% in financial, so it looks like you have 10 stocks, 10 holdings,
We
right?
do
So
own
you
10 equally weighted positions in the fund,
okay.
uh, approximately equally weighted. Yeah.
10 equally weighted. So for your financials, which is half the portfolio, you have CIBC, you have Manulife Power Corp, a Royal Bank, and Sun Life. Then you have 20% in energy, which is basically Enbridge and Suncor. Utilities, you have the Fortis. Communication, you have TELUS. Consumer staples, you have Loblaws. Right, so all recognizable companies in Canada, really the big cap stocks. Tell me why you guys decided on these holdings in particular, if you will, a little bit more concentrated versus your competition that has maybe 15 or 20, 25 plus Canadian dividend stocks.
Sure. So before we started the product, we did a lot of testing and analysis to try and figure out the optimal number of names we want to hold in the portfolio.
Mm-hmm.
We wanted to make sure that the portfolio was sufficiently diversified to remove any stock-specific risk. But at the same time, we wanted our best ideas to really drive the performance of the fund. And so we did a lot of work, we did a lot of testing. We felt that the 10 names are going to be the optimal number of names to have in the portfolio to really maximize or optimize the risk-adjusted returns for the portfolio.
Interesting, very interesting. Okay, and let's talk about, is there any covered calls on this portfolio? So some split share fund managers do a little bit of covered calls. We know that how split funds are split up, that these are highly leveraged products. So if you have really quality stocks and they do really, the portfolio does really well, you're going to have amplification. So are you guys doing any covered calls on the portfolio currently right now?
So we're not currently. We do have the ability to write covered calls.
Okay.
We haven't felt the need to do that. Our portfolio is generating a tremendous amount of income. When we started, it was yielding over 5%. Currently, our underlying stocks are yielding about 4.5%. Over the past 1 year, all 10 of our names have been able to bump their dividends, on average about 6%. And so we haven't felt the need to write covered calls to generate excess income. And we also don't want to cap our upside because we still do think that the Canadian market and our names are really quite attractively valued, in line with history and also really relative to the United States. We think there's a tremendous amount of opportunity here for the Canadian markets to start gaining ground back on the United States after some really tremendous performance over the past several years.
Yeah, I mean, these are all high quality. They have dividends already, right?
100%. Yeah.
So, and they're growing dividends as well. I
Yep.
like the diversification too. It's not, Canada is already obviously very focused on financials, but you have half of it. You have very high quality financials, but what I like is there's diversification within the financials. Don't just have the banks, you got some insurance as well, and then you have
Correct.
things like Loblaw, some anchors as well, and other sectors.
Yep, 100%. I think you sort of described that really well. Two major banks and then three insurers gives us that 50% of the financials.
Yeah.
And then we want to diversify a little bit away from it. You can get a little bit higher yield in some, for example, the telcos. The
Hmm.
utilities are that real nice anchor in the portfolio. And so I think we really have constructed with just 10 names a really nice diversified mix of Canadian dividend paying companies.
Okay, and there's I would say almost all split share funds in Canada have a $15 unit NAV rule where if the unit NAV, so the NAV of the Class A share and the preferred share together, the unit together, is under $15, you're going to temporarily suspend the distribution for the Class A shares, right? A very misunderstood but very known rule for veteran split share funds investors. Does your split fund have this rule as well?
We do have that, and fortunately, Jeff and the team have been able to grow NAV even with paying the dividend and issuing some bonus shares in February. So right now, based on the current net asset value, combined net asset value, that would require about a 40% uh, drop in the value of the underlying portfolio securities for that to kick in. But we do have that feature to protect the preferred share at a $15 combined NAV.
Yeah, I mean the net asset value of the Class A shares is 1487. For the preferred share, it's always around the $10 mark. So you're way,
Yeah.
way, way above that threshold for sure. And one of the most exciting things that as soon as I saw this is the NAV discount, right? So the fund is trading, or the stock price of NPS, and we're focusing on the Class A shares here, about 12.99. This is as of market close on the 14th of October. But the net asset value, the actual intrinsic value, is 14.87. That's an over 10% discount to NAV. Why do you think that is?
I'm happy to jump in, Jeff, and feel free to chime in. I would say we're a relatively new split share issuer, as you mentioned, Adrian. This is our only split share fund.
Hmm.
So, we may have flown under the radar screen a little bit. It's also a relatively small market cap. So, in terms of larger investors, like we've had some inbound calls from institutional or large investment advisors that would love to acquire, buy the units, but there's not enough, candidly float or liquidity for them to participate and scale across their books. But for an investor right now, we think of it as providing a really attractive entry point at about a 13% discount. You've got the maturity dates in just a little over 3 years. So in a way, you kind of think of it as a 13% buffer against downside performance of the underlying
Yeah.
portfolio, and makes for a very, quite an attractive yield on the issue price right now. But I think a lot of it is just, it's candidly part of the reason that, we want to get out there and tell the story more is we do think it's with the historical performance,
Hmm.
outperformance, Jeff and the team have done a great job. Obviously, you've had some tailwinds with the underlying portfolios and just the general market performance. But yeah, we do think it is a really compelling entry point right now.
I agree with you there. And you touched on, you said a little over 3.5 years is going to be the redemption or the maturity date, I believe, for split share funds. So in case people don't know, this is one of the most attractive, my opinion here, things of Class A shares, especially when they're trading at discounts. There's a mechanism in place, and maybe Chris or Jeff, you could explain it, because maybe I'll make a mistake here. I'm not a split share fund expert. But you're able to actually, at that point, so 3.5 years, whenever the maturity or wind up date is, to hand back in your shares at the NAV price. So if there's a discount right now, typically what happens after speaking to many split share fund managers is as we get very close to that redemption date, the shares start going, the discount starts going away because people just buy it at one price and then hand them in at a higher price. So can you explain that whole mechanism and how it works?
Sure, I'm happy to do that. You make a really good point that discount should get arbed out as you approach the maturity date. So on February 29th, 2029, so just over 3 years, is the maturity date for the fund. And at that point, even if the fund is extended and the preferred shares rolled over, every holder of Class A shares has the right to essentially cause the fund to redeem those shares at net asset value. So there's no fees associated with that. There's no caps. That's an automatic right. So yeah, as you say, inevitably, you would expect that fairly wide discount today to narrow over time. But we think that besides the TSX, and we hope to grow the fund over the next 3 years or so. But it does give investors kind of that secondary liquidity backstop, if you will, that even if it's trading at a discount in the market, there's a guarantee of getting net asset value on the maturity date.
Yeah, it's a cool feature of split share funds. It's kind of like a protection almost, and it gives you more bang for your buck for sure when you're buying these units at a discount. So what would you say to investors that are a bit worried because this is maybe a newer split fund? Obviously, we all know that the companies inside the portfolio, they're all high quality stocks, but newer split fund doesn't have a lot of liquidity, a lot of volume. Sometimes investors get worried about that. I always tell them, look, you could always use limit orders, right? You could use those. What would you say to them, to those investors, that really like the product, but it's smaller, low volume, low liquidity? What would you say to them?
Well, I think for investors that like a deal and that like to kind of find value opportunities, this provides a great value opportunity. You're right. You're not going to go in and purchase $2 million worth of stock in a day or 2 days or a week. But if there's an appetite for selectively purchasing, as you say, you could employ limit orders. You've got a fair bit of room between the current price and the net asset value.
Yeah.
So, to the extent for those that are seeking an opportunity to get real value, as I say, with kind of 13% downside protection or a 13% buffer right now, with the maturity in 3 years, we think that there's a real opportunity there. I'm not sure, Jeff, if you have anything, any additional thoughts in terms of the buying opportunity.
Yeah, so I think that's right. I would point out to two other things is that, we do pay a monthly distribution. On an annualized basis, it's $1.50. And so it was around 10% when we came out of the gate. But given where the shares are trading today on the NPS, on the TSX, I mean, you're getting almost a 12% yield. It's just over 11.5%, which I think is a really attractive feature being out there to buy it today and receive those cash distributions. The other feature is that we do have a normal course issuer bid in place. And so we see the value in the shares today at the discount. And so we have been buying back stock in the open market along with other investors. And so we really do think that the shares of NPS offer a really great deal in the market today.
Okay, yeah, cool. And a lot of split share fund providers, I think you talked about this earlier, they've done so well, especially the ones focused on Canadian financials. They've been on a rocket ship lately. You guys issued a bonus shares. Did you mention that before, if I remember correctly?
Yeah, we did do that, Adrian. Yeah, no, that's a good point. We back in February of this year, so about a year into the life of the fund, because of the strong underlying performance that the team had generated in terms of NAV, we ended up doing what effectively was a stock split, where we gave for every 100 Class A shares that a holder held, they received an additional 15 shares. So, or for one share, 0.15 of a Class A share. So those shares came at no cost, effectively increased the dividend, the cash flow coming to the investors each month by that additional, essentially 15% of their existing holdings. And what it also, the other benefit it had, in addition to increasing the cash flow, is we kind of re-levered the fund, because you start by issuing a fixed number of preferred shares representing about 40% leverage on the total assets. As you grow NAV, that preferred share issuance stays constant, obviously. So you're kind of delevering with good performance. So this is a way of kind of bringing that leverage back to the inception leverage. And we would, there's certainly a possibility of doing that again down the road. We don't want to predict anything, but that is something that is others have done, and that we would continue to look at if the opportunity presents itself.
No, that's great. I mean, 15% bonus shares is really good. Recently, Quadravest and Brompton have done similar things. Bonus shares on a couple of their split share funds, typically 10%, but this is 15, so this is even higher. So obviously the portfolio managers know what they're doing, and the stocks have performed really, really well. Just curious, are you sticking with these 10? Do you have the ability to swap some names for other names, or you really have this 10 stock conviction? I'm just curious about the future maybe of the holdings in the portfolio.
Yeah, so we do have the ability to actively manage the fund. We want to make sure at the core we hold these real core Canadian dividend payers. At the margins, we do have the ability to move some of those names around slightly, just to actively manage it, whether it's on valuation or we see a better opportunity elsewhere, there's more attractive yield we could pick up. The market from a macro perspective has changed in a little bit. And so we do have the ability to change names in and out of the portfolio, but we do want to make sure we're, maintaining that dividend yield, make sure we still own those high quality Canadian companies. They do have to be listed on the exchange. We're looking for names that are on the TSX 60, to be honest. We want at least a $10 billion market cap. We want a long history of paying dividends. We want a long history of growing dividends. We want to make sure they have the balance sheet strength to continue to grow those dividends or distributions going forward. And so we like these 10 names. At the margin, you may see a few name changes over the duration of the product over the next 3 years before the maturity date. But we're pretty comfortable with the majority of our holdings at any given time, for sure.
Yeah, I mean, it's in the name of the fund, right? Canadian large cap. So if you're just going to pick within the TSX 60, you're really looking at the big boys, right? The big cap companies.
100%. We're sticking to the mandate there.
There you go. Okay, perfect. And just curious, so there is a competition out there, similar funds that are diversified Canadian big cap. I noticed that your management fee was 75 basis points. The competition ones are a little bit lower. Can you comment on that? Is it because it's a smaller fund and you were fund, or what would you say for that?
I'd be happy to jump in, Jeff, and then feel free to chime in. I mean, in my view, first of all, 10 basis points obviously is a fairly nominal difference, I would say. But I think that the team, like I would say, first of all, it is an active approach. So even though it's equal weighted, there was the initial portfolio was very thoughtfully curated, and we can get into some of the criteria. And I think there is an active component. So there have been a couple of changes. There could be changes in portfolio names going forward, and even the decision whether to write covered calls or not is obviously can have a material impact. This isn't one of those funds that just has a 30% kind of covered call override. That's a very selective strategic decision made by the portfolio management team. And so, I think, the active component, and certainly the fund, if you look at the performance numbers that are on our website, they've been very strong. We've outperformed the TSX Composite Index since inception, consistently grown the Class A NAV while paying out the monthly dividend. So, again, I think when you factor all of that in, kind of a 10 basis point difference in fees, I like to think it's well earned. But Jeff, I don't know if you'd like to add anything to that.
No, I appreciate that. I think you alluded to the fact that we're the ones growing the NAV. We're not grinding the NAV. The NAV's not shrinking. And so at the maturity date, our NAV is going to be significantly higher. And I think we've done a good job really growing that.
Awesome, guys. Thank you so much. And maybe a final question, although we kind of touched on the point a little bit, which with much bigger funds out there, which have a longer track record, why should my viewers consider investing in NPS? I know what I would definitely say. I mean, what would you guys say to that?
Go ahead, Jeff, if you want to start.
Look, I think it's a tremendous opportunity. There's a big discount in terms of the trading price versus net asset value. I think that's an opportunity. We're paying that monthly distribution at a really attractive rate, almost 12%, between 11.5%, 12% based on the current price. I think we've already shown a track record of being able to grow that net asset value over time, which is fabulous. I think it's important to grow your net asset value while paying out that large distribution. And I think, you know, the more we can get the word out, the better the liquidity will be, the easier it will be to trade it. And I think that discount will narrow over time. So we think it really is a great opportunity to, we look at the NPS on the Toronto market here, the Canadian Large Cap Leader Split Corp.
And I would just say, you know, besides, you know, the one reason is obviously the strong performance, but we will look to continue to reward investors with that performance. And again, we haven't made any decisions as to how we will do that, but we have a number of options, whether it's a pure dividend increase on the Class A's, we can do that, whether it's another stock split where we're issuing additional kind of performance bonus shares to holders. There's a number of different things that we can do, and we'll certainly, you know, our interest is in you know, not just continuing to perform at the NAV level, but to support investors with, you know, the NCIB, other mechanisms to kind of enhance the trading, even you know, in the lead up to the maturity date, you know. So I think that lots of tools that are, you know, that we have access to be able to, you know, continue to create a positive experience for investors.
Yeah, for sure. I mean, the 12% plus discount is very attractive to you. That for me is the most exciting part about it because, and I only kind of learned about this recently in the last couple of years or so, that redemption feature. That, to me, that's what really makes the split fund Class A shares special. Number one, you have, like we just saw in the portfolio, well-diversified, high-quality Canadian blue chip dividend growth stocks in there. So you got the quality, you have the discount, you're able to give your shares back at NAV. So if you're buying them 12% cheaper, well, you could do the math. It's, you know, kind of like buying a dollar for 88 cents, right? Something like that. So thanks so much for your time, guys. I think I had one final question, but it slipped my mind. I think I was getting a little excited of that 12% discount to NAV. So yeah, thanks so much. I think you've answered everything. If my audience has any questions, any concerns, they could always reach out to you guys, right? You guys have a website, Ninepoint.
Yeah.
And if you want to learn more, obviously, I strongly recommend you go on their website, check out NPS. The holdings are there. Everything is there. The performance as well. Very, very strong performance on this fund. You have the monthly distributions. You have all the information you need. So make sure to go and check out the NPS Canadian Large Cap Leader Split Corp. I'll put the link in the video description below. And guys, it's been a pleasure and hope to have you back on the channel eventually as well.
Adrian, thanks a lot. We've been your followers, so it's an honor to finally get on your show.
Appreciate it.
Yeah, no, thanks for your interest in this opportunity and for having us on. Appreciate it.
Thank you very
Perfect.
much.
I just remembered the last thing. The last thing is there's no covered calls on this. So this is for now, a purely organic growth product that Canadians could consider. And especially if you're like Canadian dividend investor, because if we haven't talked about taxes, but if you hold NPS, for example, in your non-registered account, what you're pretty much going to get, and if you guys could confirm this, I'm guessing here, mostly eligible dividends and capital gains and ROC, right? You're not getting any regular income. You're getting very tax efficient income. Correct me if I'm wrong there.
No, you're absolutely right. You're absolutely right. Yeah.
Yeah, because there's big dividends already with the stocks. That's Canadian eligible dividends, and I'm assuming the rest is going to be capital gains / ROC. So very tax efficient as well for a non-registered. So guys, we'll wrap it up. Thanks so much for your time. See you next time.
Thanks, Adrian.
Thank you.